Welcome to the InvestSense Weekly Market Podcast for the second week of January 2026. And in fact, the first one since we got back. We hope that all our clients have had a relaxing time and haven't been watching markets too closely, and their clients as well. So if you missed it, since we last spoke, didn't really have a Santa rally. It seemed to have got lost in the post, but the start of the year, things have started with a bang. And there's talk again of the rotation trade. Now, that's actually what, if you were to sum up what happened in 2025 with a bit of perspective, it was all about the rotation trade. The highest performing asset classes were things like emerging markets, global small caps, especially outside of the US. But with a little bit of recency bias, most people probably think it was another year of US exceptionalism because in that middle part, if you see that magenta line, which is the Nasdaq, around sort of July through to September, we had a resurgence of the tech stocks, and that's the impression that probably a lot of people have got left with. But when you zoom out over the whole year, it was actually those sort of global, cyclical, diversified, little bit yieldy, little bit of growth, and we think sort of probably better value, although that's not advice, of course. But it was certainly something that worked out when you looked at the year as a whole. And the other thing which was quite distinctive about 2026 was when we had that Liberation Day upset and markets sort of fell quite precipitously. It was all of those things that were the least volatile. And that's something that we've seen throughout the year, and actually we saw overnight just the last couple of days, is that the worries of the market seem to be focused on that more expensive part, which is, of course, the big US tech stocks. Now, there's a couple of other things on our chart that are on the minds of a lot of Australian investors, and it's those two green lines on the top. One is Australian equities, which were only up about 10% with dividends for the year, which was way behind most other markets. So a little bit moribund, not a disaster up, especially with those dividends included. But certainly it was a little bit of a rocky ride for Australian investors and especially active managers, because a lot of that came from the banks, although they came off later on in the year, and also resources, which have done better in the last few months. And there was a lot of kind of mid-cap growth stocks that really struggled. And there's a lot of noise, and we'll talk about that a little bit later. And the other green line on the bottom panel is that divergence that we see between US 10-year yields and Australian 10-year yields. Now, if we end up having some kind of a recession this year and the RBA has a little bit more scope to cut again, then that will look like an opportunity. But on the other hand, if we are on these sort of divergent interest rate paths, well, maybe it's natural that that's priced in, because if the Fed is expected to cut by 50 basis points or more in the next year, and Australia, we go the other way, well, that could be 100 basis points. And if that turns out to be something that's a little bit structural in the respective economies, and that's probably the muddle through scenario, because unless you have an upset, that's probably where we'll land, well, then maybe those long-term yields are somewhat justified. However, if you hark back to the discussion we had with Andrew Hunt, he does feel that there is scope for a global slowdown this year, and so that might be, at least for bonds, at least a little bit of an opportunity for Australian bonds. Back to the big picture, though, this article made us think of a graph, a slightly complicated graph that we talked about last time, that we think is very germane on a lot of people's minds. We've had 3 years in a row. What does the fourth one look like? 2026. And it's that time of year, obviously, where people are making forecasts about the next year. And we all know that's a little bit of a silly exercise, as we'll get to. Quite often, analysts can be confounded by what actually happens. But this can go two ways. And this is the chart that we show just to refresh. And those little red dots are each time there's been returns over 10% per annum over 3 years in a row. And what's significant about that is not only that they seem to happen at the end of bull markets, but they also bunch. So when you get 3 dots in a row, which is the end of the 30s, which is .com, and something very similar where we've had 2 dots, where we had 3 years before 2022, then we had a down year, and then we've had another 3 years. So that's 6 out of 7 years. So very sort of similar dynamic. That seems to happen at the end of bull markets, and that green line is showing our version of it, or estimate of expected returns, a very rough one, sort of put back over 120 years. And it shows that when markets get really expensive, 2 things happen. At some point, you get this setback, but in the meantime, you get markets that keep keep going through sentiment and momentum. So it gives you a very nuanced view of why making predictions at the end of a bull market is very, very difficult, because you've got all that momentum. Things can keep on going, but the more they go, the more that rubber band gets stretched, and the snapback can be somewhat violent. And that's why when we look at the year as a whole, we've got a red line there, which is your sort of 70-30 passive diversified fund, up by 10%, highly creditable, as is the blue line, which is your sort of actively asset allocated fund, but also probably including some active management. And if we look at that sort of in Aussie equities and global equities, the average manager compared to those benchmarks has also struggled. And it's not just fees. It is because there is a little bit of worry out there and a bit of caution. And this is what tends to happen, is that the fundamental investors tend to do the sums and say, well, things are getting a little bit overvalued, and, be a little bit cautious. And at the same time, you've got all that momentum, and it tends to be a very difficult time to make those kind of decisions, to be an active manager. And that's the other side of the 2025 bull market that we saw. It really did climb a wall of worry and has wrong-footed a lot of people, especially Aussie equity managers, where some of the most obviously expensive things were the things that rose the most, things like Wesfarmers, CBA, although some of those things seem to be coming back a little bit now. Now, as our clients will know, one of the ways that we try and sort of look through this is our valuation dashboard. And although it looks like 10 years, sometimes, as we say, the long term happens in the short term. And so, that line you can see in front of you, if you join up all those dots, that sort of forward-looking risk-return line, so sort of risk going out on the horizontal axis and returns on the vertical axis. If it's really flat, it tells you danger, Will Robinson. Markets are maybe a little bit expensive, get a little bit defensive. If it's very steep, it's telling you the opposite, that you're getting a lot of return for the risk that you're taking on a forward-looking basis. And if we take that to the end of December 2021, when actually people were getting quite bullish, it tells you something. All those fixed income assets there, sort of around 2% yield, because inflation was very low. But if inflation did come back, which is what happened, obviously there was going to be issues there. But also the other thing that we talked about at the time was that transverse relationship. There were some things like US equities, which looked, we thought, sort of pretty obviously expensive on a long-term basis, and there could be a short-term reset. And then up the other end, less risk, which is not what you should see for more return, was things like global small caps, emerging markets, UK equities, things like that. And what actually happened in 2022 was that those things were quite resilient, and things like US equities fell by more. And in situations like that, it's there's a narrative, and it does seem to give you a little bit of indication. And if you roll that back over time, you can see that. And as our clients will know, when you get that dynamic graph up on the portal, it's something that you can take clients through. Now, the problem where we get to, and this is very resonant to the conversation we had with Andrew Hunt before the break, where he actually said, I don't really want to give any end of year predictions because I think it's a bit messy and complicated, and now's not the time to do it just because it happens to be the end of the year. And look, we feel like that a little bit when we look at it an asset class perspective, because that line's a little bit kind of, well, it's sort of in the middle, isn't it? It's sort of shallow sloping. Obviously, things are all a little bit expensive. But what's really interesting about this in polarized markets is all the interesting stuff is happening within markets. So if you look in emerging markets, you've got things like Korea and Taiwan, which look quite expensive, and other places which look sort of cheaper. If you look within our local market, you've got the banks, which probably still look quite expensive. And so that dot would probably be, and demonstrably quite low, because yields are not what they were, and the growth prospects, well, it's difficult to see where that's coming from. So you end up with a very low expected return, and with that comes some risk. And then you've got the resources. Well, that's something that's difficult to predict because it could go anywhere. It's very globally cyclical, and everyone's sort of quite aware of that. So that's probably a little bit of a wild card, and then you're left with the rest. Is it cheap or is it not? And again, it would be great to have a simple narrative around that and say, well, the rest of the market's just ridiculously cheap. Yes and no. So that's one of the things that we're going to be digging into and trying to sort of dig within those risk premiums within markets and see whether that presents an opportunity or the extent to it does, and how granular it is. Is it a stock picker's market, or are these sort of thematics that have been blindsiding investors, could they continue for more? And the other thing, when you're thinking about within markets, that obviously the US kind of looks, sort of okay okay, really, not as expensive as it was. But within that, there's a lot of difference. And when you look at the tech stocks, well, there's certain scenarios where actually they could be quite cheap. If Microsoft continues to grow for 15% per annum for the next 10 years, it's probably quite cheap. But if it can't do that, it all of a sudden looks quite expensive. So that makes the upcoming US earnings season quite interesting, and the ones that follow, because markets, those valuations are quite lofty. And if they prove to be justified by excellent performance, well, all well and good. But they're vulnerable to disappointment. And that's what the market's been worrying about the last few days. And that brings me to a chart that was done just before Christmas by one of my colleagues, Phil Andronico. And it kind of talks to the same thing, that actually you've got to be careful of these predictions, even if you do have a strong view. And what this chart is showing, and you probably won't be able to see all the details. So, please ask your PM for a copy of this, and we'll put it in the link in the article on the portal. But what it's showing is, if you look at that green line, that's the S&P 500. And if you look at those sort of band of dots, that's the various predictions from different analysts about where the S&P 500 would be. And it's a familiar pattern. So if you look at the end of December 2021, you can see that even though a lot of people had been, quite bearish the year before, just after, during that COVID episode, by the time it got to 2021, markets were projecting, the projections for 12 months forward were very, very bullish. And then 2022 happened. And then when you get to the next year, people were a lot more bearish, but actually they were surprised. And then again, the year after, remember, that was when everyone was predicting a recession that didn't turn up. And then again, people were surprised. And then we've had another year of that, when most people's expectations were outpaced. And now we're in a similar situation where most analysts, and if you look at that range, they range from kind of steady to up by 10 or even 18%. Analysts have got sort of relatively bullish again, but just because people predict something doesn't necessarily mean it's a good thing, and it might well mean the opposite. So maybe that's a little bit less than satisfying, the fact that we don't have this sort of bold prediction or a clean narrative to say these are the places where you can hide, like we did back in 21. So we'll just finish off, talk about some of the things that we're going to be looking at over the next few months to try and distill some kind of a narrative from this, to get some kind of direction, because we're aware that, especially at the beginning of the year, it's less than satisfactory not to have that sort of clean narrative to go out to tell clients. But the fact is, it's a little bit messy. Markets are a little bit expensive, but the catalyst isn't really clear. First of all, the next earnings season, in the next few weeks, we'll be watching that quite closely. And if anything interesting happens, we'll be talking about it here. But the key question is, will those valuations be justified by the strength of earnings? And the estimates are that people are expecting much more of what happened last year, which is dominance of US tech, information technology year on year, expected to be around sort of 20% earnings growth, and the rest a little bit more moribund, but reasonably stable, up 5% or so. Anything around that or anything less than that could cause some issues. And then there's the US credit cycle with a lot of issuance going on. Seems quite healthy, but spreads are very tight. And there has been the odd rumblings in the private credit area at the end of last year. So something to sort of watch out for, and something that we know that Andrew Hunt is doing a lot of work on, and we'll be talking to him more about that as well. And then with that sort of 30% rise in some of those sort of yieldy, cheaper global diversified cyclical asset classes, like emerging markets and global small caps, up by 30%. Does that mean they're still good value? We'll be talking to a few fund managers and kicking the tires. We think probably that's still an okay space to be in. But what's kind of interesting is that there's other areas that have been more neglected, for instance, in the quality space on both the value and the growth side of the spectrums, where actually maybe there's a little bit of that asymmetry that we saw back in 21, where some areas had really been neglected and they got to a point where maybe they were quite investable. So that's a potential line of inquiry. And then lastly, we'll be talking to Tim Binstead, of our head of Australian equities, about how you model different risk premiums within the Australian market, and whether there's any sort of broad conclusions that you can draw. Is it a stock picker's market or still a bit of a minefield? So quite a lot to chew on, and that gives you a sense of what we'll be talking over the next few months, and look forward to making a start with that next week. Thank you.